Hello and welcome to Commodity Culture. My name is Jesse Day, and this episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. We are continuing with our 2023 Sunset series where we look back on the year with a variety of experts in the commodities sector to find out what surprised them, what went according to plan, and what they're anticipating for 2024. And I'm very happy today to be joined by the founder of Momentum Structural Analysis, somebody I always love talking to. It's Michael Oliver. Welcome back to the show.
Good to be back.
Yes, happy to have you back. And let's start off with a broad question looking back on 2023. And that is, what went the way you thought it would and what surprised you?
Everything went pretty much as we expected. The stock market, to get off the subject, but it is related to commodities because it can be very important. Asset reallocation by asset managers are still having a attempted recovery rally after what we described as the top in January of 2022. Prior tops in the S&P were in 2000, 2007, and those were protracted topping patterns as well. The issue is what happens to other asset categories when stocks become unfun, okay? And I think in 2024, you're going to see a very beat up stock market in the US in particular, because we're the biggest bubble of all the stock markets in the world in terms of how much did we go up over 2009, 2021. You break that bubble, and I think it started to break. I distrust this rally very much that we're seeing. By the way, it's highly limited to a few tech stocks, by the way. You look at most indices of the U.S. stock market, like small caps, mid caps, consumer discretionary, financials, they're laying on the mat. Well, the S&P's having a party. Okay. But when people get dissatisfied with a prime asset category, and when asset managers get dissatisfied, they look elsewhere. And one asset category in particular is commodities. Now, we've heard all this 6-9 months ago when the Fed was raising rates and so forth. The commodities are exploding and all this stuff. But year over year on a percentage basis, there was a big bulge, especially in 2021, a full year before the Ukraine-Russia war. Okay, so they want to blame it on that war. Well, heck, commodities peaked 1 month after that war commenced. They'd already had their move. So you can't blame that commodity move that began in late 2020 and lasted until March of 2022. You can't blame it on an external excuse. It was some reallocation of assets into a very depleted category, commodities. How depleted? While stocks were laboring at all-time highs, I say laboring because in 2022 they labored, okay, they dropped and so forth. Commodities were coming up from basically what we called theoretical zero levels. The Bloomberg Commodity Index, for example, was trading as low as just below 60. That's the price of the Bloomberg then, BCOM. If you go back to 2008, it was 237. It dropped, and then in 2011 came back up to 170. And it was trading in below 60 in late 2020. Now, gold had already doubled from 2015 to 20, so it didn't correlate. The commodities were still going down. But they all in unison, we put out a report in October of 2020 and said commodity explosion about to happen. We used the word explosion. Bloomberg went from 60, 70 level, our breakout was at 70, and doubled and went to 140. Okay. Now, percent-wise, over a short period of time, that's a huge move. But on an actual price basis, even 140 wasn't back to the 170 it was in 2011 or the 237 in 2008. And then it sunk from 140, which was an intra-month spike, by the way. Top close was like 130 on a monthly basis. And you've pulled back, and now you've cratered around the 100 level, the low, let's call it 100 to 105 zone. And you've been stuck there for the last 6 or 7 months. Still well above the 2020 low, but also very low, historically speaking, in terms of where was the commodity category versus 2008 or 2011. We think the pullback is two support: annual momentum support, which is a metric we use to measure. We don't look at price primarily, we look at momentum of price. And in this case, when we called the commodity upturn, what we were looking at was the Bloomberg measured against its 36-month moving average. Not whether it was below it or above it, but the structures that it had built. When you plotted a momentum chart, you could see basing pattern. You couldn't see it on a price chart, but you could definitely see it on momentum. And we broke out well before even getting back up to the 36-month, but exploded and doubled in price once momentum broke out. Since that time, the Bloomberg has pulled back down to the vicinity of its 36-month average. And also next year, its 3-year average, which is rising to about 105 level. So it's going to be around that level. We regard that as support. Okay, now, it's been a very mixed picture over the last 6-9 months where, for example, commodities were led by energy, oil, natural gas especially. We had like an objective on oil that was achieved, not that it's an ultimate objective, but enough for time being. And since then, it's pulled back into the 70s, or actually high 60s at one point. Now it's in the mid 70s. And it's not a leadership component anymore in the commodity category. And certainly natural gas isn't. It went from $10. Our target was 9. It got to 10, and then collapsed down to the $2 area, to upper ones, excuse me. It's trading in the twos right now. So energy hasn't been a contributor lately. Sugar and cocoa have, for example. They've gone up very strong. So they've sort of balanced it out. Gold is a component of the Bloomberg, and it's gone back to its all-time highs at 2000. So it's a helpful component in the commodity complex. But what we're watching right now, if I were to pick the sector that probably is going to take over leadership in terms of the best performing class within commodities, I'd say the grains. They've been beat up worse than has oil. They had a big move in 2021, 22, but they had a huge pullback, especially wheat. But our technical analysis looks like in the upturn that we expect in 2024 out of the category, broad category, is likely to be led by grains. And of course, if that occurs, that's probably one of the most painful areas for the average person. Gasoline in their tank is one, but food on the table is another. And I think the grains are going to lead the next upturn.
Very interesting. Now, when it comes to investing in the grains and trying to get some exposure to that potential upside, how does your average retail investor get access to that sector? Is there ETFs? Are there agricultural equities that they should maybe be taking a look at? Obviously, futures is a very dangerous place to play unless you're very adept in that area. So what are your thoughts on how your average investor can get exposure to grains?
Well, without specifying the names, there are, if you go on Google, you'll find that there are ETFs for soybeans, corn, and wheat. There's also a broad, I think it's DBA is the symbol, agricultural segment of the commodity sector that has an ETF as well. So there are arenas you can do it in if you want directly access to the commodity itself. There are other ways to do it, and that would be grain-related companies. That are out there. There's many symbols that are connected to production and sale of grains. And those stocks tend to perform with the grains. In other words, they don't look like the S&P in terms of what they've done. And therefore, if the S&P goes down, they go down too. No, they'll reflect the grains. So that's where I'd be looking if I were solely focused in the non-monetary metal aspect of the commodity sector. I'd be focusing on grains this year. And there's various mediums to do it that don't require leverage or anything of that sort.
And you touched on energy there and how it performed very well. And at the moment, as you said, WTI is in the $70 range. How do you see energy performing in 2024? Obviously, there's a lot of catalysts people are pointing to: OPEC extending production cuts, the decline of U.S. shale oil production, and just a general underinvestment in the sector over the course of the last decade that might turn the other way as we are kind of starting to see the ESG narrative and the investment in ESG kind of taking a turn for the worse in many cases. What are the catalysts you see for oil in 2024? Your thoughts on, could we see natural gas rise up again? Maybe not to the highs they were at before, but at least higher than they are now. What are your thoughts on energy for 2024?
No, I do think the energy sector is in a support zone. Okay. Now, that means it's probably from an investment grade point of view, again, not futures or leveraged or time sensitive. I think that you can look at crude oil and basically say somewhere in the 70s is probably a good place. It's a catcher's mitt. And the issue is, how long does it take to come up out of here? And two, and I suspect that you're talking a quarter or so, maybe it takes to labor to come up out of here at most. But the potential on the upside, I just don't think it's comparable to what the grains will do. But that doesn't mean it's not going to participate again. I just don't think it'll be the standout leader that oil and natural gas were on a percentage basis in 21 and 22. But I do think there, and I'm speaking technically now because we're technicians, but we look at the micro stuff, but we're looking at the big technical picture. And frankly, oil and natural gas both look like, from an investment point of view, it's a safe area to be probing. Okay. Don't expect much more downside. The issue is, how long does it take to come up out of here? And again, I don't think it'll take too long. And two, what are the upside dynamics compared to, for example, the grains? And I think the grains will beat them. But I think energy is safe. Now, the standout, and I don't think it's part of the Bloomberg, is uranium. Uranium is stout. It's not reflecting oil and natural gas pullback at all. There's an ETF of uranium-related companies, URA, it's quite dynamic right now. In fact, you wouldn't know it was an energy sector, but it is, and it's plowing to pushing all-time highs. So apparently, the world is giving up on the notion of windmills and solar farms, and they're going back to nuclear again, which is fine and dandy anyway. But uranium reflects that. I also understand, and I'm not a fundamentalist in oil, that even during recessions, which people keep talking about on TV, that, if you have a recession, oil is going to drop because demand will drop. No, I understand that actually energy consumption does not drop during recessions. It's sort of an essential. You can't sort of quit using it. Other things may drop, but not energy. And it doesn't correlate, by the way, the oil stocks like XLE, which is the ETF of the broad energy complex. If you look back historically over the last 10, 20 years, it doesn't correlate well to the S&P at all. There's periods when the XLE has been cut in half and the S&P has gone up. So don't make that false linkage that, if we go into recession, commodities get hurt. No, they're an undervalued asset category. And when people get discouraged with stocks, and I think they're going to be by late this year and early next year, they're going to feel the pain again. At that point, they'd have to move somewhere else. And I think the stellar place for them to be will be gold and silver. But in the broad asset categories, I think commodities in general and commodity-related stocks will be a place to be and perceived to be a safe place to be.
Well, let's talk about gold, because before we hit record, you were discussing the collapse of the U.S. Treasury market and what that means for the future of gold. So maybe you could talk about that for the audience, because it was very fascinating.
The trend direction of T-bonds, and we're talking price now. So if price goes down, yield goes up. Okay, remember that. T-bonds we got bearish in 2020, late 2020, well before we got bearish on the stock market in early 2022. But bonds started a major bear market then, the yields rising. Okay. They made a low last October, a year ago, at a level that we predicted would be a bounce point, but only a bounce point. And sure enough, they had a nice bounce. They ran up nicely and they stabilized. Well, you'll notice last October, stock market also made a low, and so did gold. Gold was in the low 1600s. It was a bear trap low, we defined it as. Meaning, if you sold that downside breakage, you're caught in a bear trap. Okay, and sure enough, it exploded back to 2000 again. But during that same time, T-bonds rallied from the October low. S&P rallied. And T-bonds then leveled off and basically peaked around March or April of this year. It started to roll over again. What did gold do? Same thing. In other words, T-bonds were technically in linkage with gold, which was very interesting because it doesn't always happen, but sometimes it does. And we defined that months ago that watch the T-bonds and gold because they seem to have their legs strapped together almost week by week. And we made a difference though because we saw gold pulling back and it dropped into the 1800s, this October. Whereas T-bonds crashed. They didn't just go down. They took out last October's low, which would be like gold being below 1600 if it had matched it. And well below there. And they did it in crash mode. There was the T-bond chart. If you looked at it, it looked like some collapsing commodity market. Didn't look like what the U.S. government debt market should be looking like. I know it had to vastly upset Yellen and the central bank and the Feds because that's the asset they can't have crash. They don't care about NVIDIA or something like that. If that happens to go down, they couldn't care less. But their T-bond market, that's life or death for them. And so we argued that expect a V bottom in the T-bond market. And in fact, we've gotten one over the last month. Lag to gold. Gold turned up about a month before T-bonds did, but then T-bonds got back in sync with gold and had a sharp rally. Now, gold was back to its all-time highs, but T-bonds were having what we call a V bottom. And I think in part that was due to overnight buying by the Treasury and the Fed in the dark type buying. And there's also some very large asset managers out there who realized that while bonds were a horrible place to be last year, they were even worse than the stock market. So the 60-40 portfolio was lethal. That the bonds were oversold now and likely to be worth buying. And I think they plowed into the bond market. That's why you're getting this V bottom. But I suspect what it means is, and I think the broad market interprets it partly as one of the factors, the Fed can't raise rates anymore. No matter what they want to say, they cannot do it. They cannot destroy their bond market. At all costs, they have to print, whatever it takes to support that market. So I think the stock market right now is pricing that in. I think gold has all along priced that in, meaning it's always known that when the paper asset bubble breaks, stock market, the central bank will have to revert back to that which they do best, which is monetize debt, print money, cut rates at some point. That's why it keeps coming back to its highs. Find me a commodity, or find me any asset almost on the planet that has kept coming back to its highs. Gold is the one, okay? It has a reason for that. And we don't think it's going to stop at 2000 this time, by the way. But I think that what happened to the T-bond market is critical in terms of the change in the Fed policy. Now the debate among analysts and stock analysts and talking heads on financial TV, it's not about whether they're going to stop raising rates. It's when are they going to cut? That's the debate now. And they're correct in that. I suspect it's going to be sometime in Q1, not Q2 of next year. But we'll see. But gold knows that. And gold is a monetary metal. It will reflect the degradation of the money unit.
And your thoughts on silver as we move into 2024? Sentiment in the sector very low, particularly when it comes to the miners. Whenever I post a video that focuses on silver, the comment section is filled with people bemoaning their fate forever holding physical silver, claiming it's never going to do anything. Paper manipulation is so rampant, it'll never stop. And it's the worst investment they've ever made. So I'd like to get your thoughts on what you see for silver up ahead.
Totally opposite that. Yes, it's been a horrible 3 years of plateauing by silver. While gold went sideways with repeated highs over 2000, silver went into a gradual declining trend channel, which we've actually sort of emerged out above if you look at just price even. Where you make a high at 30, you make a high at 28, you make a high at 26, make a high at, et cetera. So it's been gradually decaying with some nice spike lows down there. Like we were $17 last year. Now silver's 23, 24 zone. Well, percent-wise, that's a bigger move up off the low than gold is off of its October low last year. But still, people have been bemoaning it. We think silver's broken through every technical hurdle we need to see to indicate it's restarting itself. Another major up leg. The last signal we're going to offer, and we get very specific with our subscribers, but basically it's if you get back over 25 again, put your helmet on. Now, if you look at a price chart, the last two highs, I think it was July and August, were just above 25. So getting back there again, somebody's going to say, well, let's sell it again. Better not. I think silver goes through that 25 level. It's going to take out 30 in a heartbeat. And I think silver is going to percent-wise vastly outperform gold over the next year. And a major point we're making too. The prior bull trends in gold lasted about 9-10 years or so. It's early 70s, it was in the $30 zone, went to 850, okay, by 1980, okay. 2000, year 2000 was trading around 250. By 2011, it was 1920, okay. But a decade or so. Most of the percentage of the price gain of those bull markets came in the final year of the bull trend, meaning the 8th or 9th year or 10th year. We're now 8 years old, bottomed in late 2015 at 1,050. We've doubled since then in gold. Okay, so it hasn't had the ratio move of those moves, which were eightfold moves. We've only doubled. And yet we've got these macro fundamentals that could drive it a lot higher. But you've got to be careful, because late in the trend, after laborious bull trend, that's when you get this engagement that is so dynamic that it takes your breath away. Like, for instance, I think it was back in 2010 or so to 2011, silver went from like $20 to 50. Did most of its move in about 3/4 of a year. Same was true in 1979. Silver exploded and got up to 50, or, it did most of it in 3/4 of a year in 79. We're getting late in this bull trend too, so it wouldn't shock me that either 2024 or 2025 is that year where you get verticality, especially given the fundamental and technical dynamics in these other asset categories that will drive the Fed to liquidity issues again, which will fuel the gold move and silver. Ratio basis. Silver to gold, if you look back historically over the last 50 years, you'll see it's gone up to 6.5% of the price of gold. It's been multiple times well over 3% of the price of gold. So it's not like it's rare for it to be there. Right now, it's above 1% of the price of gold, like 1.3. If gold were to match the ratio moves that it had in 1970 and 1980, or 2000 to 2011, it would go to $8,000 and merely match the ratio, eightfold. If silver were even 2% of the price of gold, or 3% of the price of gold, and gold was at 8,000, you do the math. It's off the page, hundreds of dollars. We don't think it's a ridiculous assertion. And I think that a lot of that is going to occur late in this bull cycle, which began again from the 2015 lows. So I think silver is going to be an outperformer. Also, I think the miners, and they do this repeatedly, they underperform. They go with gold, but when gold pauses, they pull back. Gold goes sideways, they can pull back. And they're very depressing. But then when they get reborn, go back and look at the spring and summer of 2020, for example. Did you want to own gold then, or miners? Miners beat the pants off of gold on a ratio basis. Yeah, it was only 6 months or so, but it was huge. I think they're positioning again for another such move. And we measure the spread relationship between the miners and gold and silver and gold. So we don't just look at their price charts and say, well, this was, et cetera. We measure them via spread analysis and momentum of the spread. And right now, it wouldn't take a lot for silver to re-engage into a positive mode versus gold on a relative basis, and for the miners to do the same. And I think GDX is on the edge of that. Remember, GDX, I think 17% of it's Newmont and Barrick. And if you look at what happened to them over the last couple of weeks, percent-wise, quite an upturn, which indicates to me that some large asset managers are moving into the blue chips of the miners for some reason. We know the reason.
Yeah, and that leads me into a question about institutional investment in commodities. Do you think 2024 will be a year when we see greater inflows from institutional investors into the commodity space, perhaps into gold as kind of a safe haven asset that could replace treasuries? What are your thoughts there?
Yeah, I think so. I think, first off, the T-bond rally we're seeing now, we expected it to be sharp, and we expect there's more. Could last another quarter of a year or something. It won't sustain. The long-term annual momentum trend of T-bonds is negative. This will be a counter-trend rally, but one that may shake you if you're a bear on bonds. The stock market will not be benefited by the drop in yields that we're seeing right now. Everybody's cheering in the stock market. Oh boy, oh boy. I suspect within the next week or so, we're going to start to see the beginnings of a rollover in the stock market. It won't be dramatic. It won't be crash. It'll be a slow arm wrestling process where this rally fades. And I think by the end of the year, early next year, stock investors will realize, oh gosh, I fooled myself. I believed if the Fed would pause and then hopefully cut later, that's good for the stock market. No, it's not. Go back and look at the 2000 top, 2001 top. The Fed cut rates. In September 2007, the market topped within 4 weeks. It started a bear market. In January of 2001, just coming off the 2000 highs, the Fed started cutting rates dramatically. Did that stop the stock market bear? No, it accelerated. So any change in Fed policy towards softening again, which they're definitely going to do, is not going to help the stock market. It's bad news. Now, what does that mean for commodities? Your question. They have to move the money somewhere else. And if they perceive that cash is depreciating in real buying power value, Ray Dalio a year ago said, quit looking at the price of your stock. Look at the underlying value of your money unit. It's degrading. And it's going to start degrading again when the central bank goes back to what they do. Gold will be a prime alternative in silver, monetary metals, but also commodities being an undervalued asset category with stocks there related thereto. I think when the money starts to flow out of the stock market, that will be positive for commodities because it has to go somewhere. And cash is not where it's going to go. It's going to move into big name ag companies, make perhaps the grains themselves, and gold miners. So I think the rollover in the stock market is important for that reason, is that assets have to move once they perceive that that category is no longer working.
So you mentioned that you expect the Fed to keep monetizing debt, more money printing up ahead. Do you think 2024 is the year that the Fed and maybe the ECB as well start cutting rates? There's this higher for longer rhetoric out there. Could that turn out to be true? And how do you expect things to turn out, and how do you expect it to impact the broad markets and commodities as well?
The Fed keeps talking about data points. Okay, now already some of the data points have started to soften. We know that. Okay, and some of the data points that they want to soften, like CPI and stuff like that, those are lagged to reality data points. They've always been lagged to reality. By the time you see them turn negative in a big way, the stock market will already be deeply on its way down. Okay, and so the Fed at that point, when they have an excuse that fits their academic arguments, they will begin to cut. Because remember, their other job is to protect employment and so forth. Well, that'll shift very quickly, but it'll be lagged to reality. So that's why we're watching the stock market, because it will be a leading indicator of when the data points are going to shift. Because once that stock market, I'll give you a number right now. If you're long the stock market, based on our annual momentum studies, which are already negative, by the way, if you ever go back down again to about 4250, remember the recent low was just above 4100. If next year you find yourself down there, which is to say, 300 points below where you are right now, no big deal. It's not a big percent. They're going to blow the bottom out of it. Annual momentum says you're gone. That's your final sell signal. We think once that happens, the data points will follow and the Fed will immediately then admit and shift their policy. Already behind the scenes, I strongly suspect, and I don't watch the data points, their monetary figures, but they've started buying T-bonds. So no doubt that while they've raised rates, on the other side, they've started to buy T-bonds, meaning print money at any cost. So there's the other side of that ledger, which isn't so much watched by the public. But I think, yes, they'll cut rates. And I suspect they'll have an excuse to do it not in Q2, but in Q1. Wouldn't shock me at all. But again, they'll be a lagged indicator. They always are. They're always behind the game. Once their bubble breaks, then they try to rescue it, but it's too late. And this is the biggest bubble in U.S. stock market history. A 7-fold by S&P, 16-fold by NASDAQ over 12 years. No prior stock market ever went up that much over that lengthy period of time in the U.S. Even the 1929 top or the dot-com top don't even compare to the ratios of moves and the duration that the monetary policy of the Fed created between 2009 and 2021. So, yes, I think they'll cut rates, but don't wait for it. It'll be a lagged indicator.
And you mentioned that those who were invested in the 60/40 portfolio have not had a great time of it. So I'm just wondering if you think we're entering an era where investors need to be more nimble and where the process of just dollar cost averaging into an S&P index fund, putting some fixed income in there to offset volatility, this kind of mantra that's been propagated throughout the retail investor community over the course of time, is that headed in a different direction? Do people need to start paying more attention to where they're allocating their capital?
Yeah, the old notion used to be 60% stock, 40% bonds, and the bonds would balance out the stock market because they didn't tend to go together. Well, they've gone together, especially last year. S&P down 20 something percent, Nasdaq down 30 something, bonds down over 30%. So they got killed in all the 60/40 portfolio. It didn't work at all. By the way, and we keep pointing this out, while those markets had a big percent down year last year, gold had an unchanged year last year. It closed in the 1820s. That's where it closed in 2021. So, in a relative, if you owned the asset from late 21 to 2022, you got killed in the 60/40 portfolio, but gold was just sitting there sideways. Why? Somebody was buying it. And of course, now we're near 2000. So, it's outperforming for a reason. And yes, I think the flow will go to gold primarily and to commodities secondarily. And it'll be because it's painful. Now, also the T-bond rally, while it's attracting money right now, and it should because it's vastly oversold, technically ripe for a bounce, but it's a counter trend rally and it won't sustain. And when it finally does roll over again, and I suspect that's going to be well after stocks have already gone back down and are making new lows, but sometime in first or second quarter next year when T-bonds roll over again, then that 40% balanced portfolio won't look so balanced anymore, in which case you're left with very little but gold in an undervalued category called commodities. So I think that the deck is packed for commodities and gold for 2024, period.
Well, we've discussed a ton so far. When it comes to commodities, we've touched on the grains, energy, gold, silver. You mentioned uranium as well. Are there any other commodities that you think people should have on their radars as we move into 2024?
No, that's pretty much my focus. I know you noticed that meats have had a huge move. Now, not that they're not going to move further, but you've missed it. Okay, our buy signals for cattle were a long time ago, way under here. So you don't want to get on train late. And right now, I'm saying the train is about to turn on the grains and from very depressed levels. So, from an optimal point of view of risk reward and getting on the train before it starts, I would watch the grains closely, and our subscribers will be kept in touch with that, week by week in terms of okay, corn just turned through something important, wheat did, et cetera, et cetera. And they all look very interesting because from our momentum perspective, forget the price charts. They all have what we call ripe basing structures. Because if you saw the momentum chart as opposed to the price chart, you'd say, wow, ooh, that looks like a bottom. Okay. When you look at the price chart, you can't quite see it. But our momentum charts indicate no, and it's a fairly wide base as well, meaning, the bigger the base, the bigger the building. So now that's our prime focus there is the grain category. And again, like sugar and cocoa, they've already had some good moves from earlier breakout levels that we defined. But no, it would be focused on the grains primarily. And of course, gold and silver, which are included in the Bloomberg, but I sort of intellectually separate them because they're really monetary metals and they don't always move in sync. While the Bloomberg was going down from late 2015 to 2020, gold doubled. So they're not always in sync. Now, the late 70s, they were in sync, for example, when gold went from, up to 850. Commodities rode the tail. They didn't go up as much as gold, but they were riding too. So I think it'll be similar to that, where when next leg up in gold, commodities will participate, but not to the ratio extent that gold's going up.
So the goal on this program is to make people better investors in the commodity space. I think the conversation we've had so far has definitely led to that outcome. But before I do let you go, I'm wondering if there's one thought, one idea you could leave with people that they could apply to their own investing when it comes to the commodity space, perhaps mistakes you see people making, or strategies you think people should be paying more attention to on the retail side of things?
It depends. Each investor is different, and some have vast amounts of money they can put in. They could ration some of it to highly leveraged positions, and commodity futures aren't that necessarily leveraged. Yes, you can use leverage, but if you have enough cash in your commodity account, you can actually have the amount of money that the contract's actually worth. In which case, you're not using leverage at all. If you use options, you need to be well timed, and quite a few of my personal positions are option related, especially in silver. Go out to next year expiration and not far from the money type of thing. But it really depends on each investor in terms of what your risk capacity is, your tolerance, and expect counter trend moves. All bull markets, all bear markets will kick you in the shin at some point. So don't get disillusioned every time you see savage downticks. In fact, if you go back and look at those tail end moves that I mentioned in silver and gold in the final year of those 9-10-year-old bull markets, it was in the middle of those dynamic moves, you had one heck of a down month. I found that quite interesting, that even in the dynamic phase, there was 1 month on the downside in gold and silver where you said, oh, it's all over. No, it wasn't. Okay. So if you get invested, always be ready intellectually for that kind of kick in the shin. It's not just going to go to the top and top. It's going to go to the top and build the top, okay? And we'll usually have some indication of that. But anyway, so I think the dynamics are about to begin for the commodity investor, especially in 2024, where you'll stand out. And the question is the leverage, which markets, and that's entirely up to the investor and his tolerance.
Very well said. Thank you so much, Michael, for joining us today. For those who want to learn more, could you tell us about momentum structural analysis and what it is you do there?
Well, we've done it since 1992. I used to be on the future side of the business. My boss and guy who trained me in 1975, 76 was David Johnston, who was chairman of the COMEX at the time, in the late 70s up to 1980. He was head of E.F. Hutton's commodity division, which is where I started. But in 1992, I started the research report, Momentum Structural Analysis, at the request of a major bank in the U.S. that sort of liked my research and said, would you sell us your research? And okay. I got out of the future side. I'm glad I did, in terms of being a broker. And we only had institutional clients up through 2014, 15, and then we opened it up to retail subscribers. And our website is olivermsa.com for Momentum Structural Analysis. And you go there and you can see discussion of our methodology, some of our archived reports, especially on the stock market, and learn about us. And you request a sample copy of our reports. Be happy to forward them to you. And we cover all 4 asset categories: stock markets, bond markets, commodity markets with an emphasis silver and gold, and foreign exchange.
Great. Well, I'll put a link in the description below to Momentum Structural Analysis for people who want to check that out. Thank you once again, Michael, for coming on. Definitely looking forward to chatting again with you as well.
Thank you much, Jesse.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.